Welcome, everybody. Scott Riley, the Market Update Desk. August 7th, we're back in the Cabana office. Temperatures definitely cooled down here in West Michigan last night. The market's still moving around somewhat volatilely. Let's kind of cover what's happening today. Um, One of the things that I was reading today is we talked yesterday about the carry trade happenings that's going on Wall Street, how that's affecting the yen and the dollar and the stock market. So, if the Fed cuts rates in September, this, which is realistically going to happen, it's a question of how much, this is going to cause the US dollar to weaken versus the Japanese yen. And this could lead to additional unraveling of the carry trades. So, it's likely not going to slow down with that carry trade factor, adding to the volatility of the market. It's probably going to increase. This is one of those counterbalance points to having a lower Fed funds rate. Mortgage applications, as you would expect with rates coming down the end of last week, purchases applications are up 1%. Refinances up 16%. If you haven't taken advantage of it, you really want to make those phone calls to people like myself, experts, to help you save some money with the new rates that are out there, especially if you got a loan a year and a half ago. Today, the Fed came out with its household debt and credit reports. What that's showing is the aggregate debt for American households um, from last quarter increased $109 billion. It's showing that savings are depleted and more debt usage is happening, which is causing the consumer to spend less or spend differently than what it did before, which is causing a lot of the concerns on the consumer because a lot of our economy is built on consumer spending. 90-day late payments on cars and credit cards are now at a 13-year high, 2014, I'm sorry, 2012. So now keep in mind, that was when the unemployment rate was 9%. We're at 4.3%. So if we go up in unemployment, which we really realistically could, that's going to put additional pressure on consumer borrowing and reduce discretionary monies. Now, those using buy now, pay later programs, now keep in mind, those weren't even there back 13 years ago when this last report was equal to for consumer debt. 43% of those are delinquent. Now, delinquent means 90 days or more late. And in fact, 50% of everybody using buy now, pay later are using those for necessities. So they're choosing to advance payroll money to now and pay a very high rate because they have to have things because they're short on a month to month basis. Housing inventory. Interesting information. Housing inventory, which is good, is up 5.3% month over month, 37% year over year. But now keep in mind, that's still only 30% of the pre COVID levels for total inventory. So we're still drastically down. When we say we're up 37%, it's from an extremely low amount. So keep that in proportion. In fact, there's only 4 states that have positive home inventory. That's Texas, Idaho, Florida, Tennessee. And in fact, 3 of those states have less net inventory. And what do I mean by that? It means the population grew by more than what the listings were. So when we look at this increase in listings, we have to understand population growth has gone up dramatically. So when we say housing inventories are up 30%, we have to factor in we have much more population. So those inventories have to increase dramatically year over year to even keep pace on a neutral factor for population growth. So keep that in mind when the media is talking about, oh, we have all these additional listings. We could have a housing issue and a decline in value. Once again, they're not going into the meat and potatoes of it, and they're simply trying to state a a headline to help to get you to watch what they're saying, but they're not going in depth like we do here to help you understand the full scope of it. Today we do have 1 o'clock. We have a 10-year bond auction, which could end up being pretty juicy. I think the investors and market are going to have a very good appetite for the bond market, the 10-year, because they're going to want to lock in the higher yields that we have now versus what we could have just on the horizon, which would be lower yields. That could give us a little bit of a benefit as we go into the back half of the week. We're a little bit better now in mortgage-backed securities and 10-year treasuries from where we were at the beginning of the day, but the 10-year treasury now is at 3.94 when I just looked a minute ago. We started, a couple of days ago at 3.78. So we had this huge decline. Then we had some clawback. The goal here is to really try to keep it under 395, 396 so that we can get to the end of the week and then look for inflation numbers next week to help get that 10-year down, hopefully below the 3.8 mark again. Give us a call. We'll help you figure things out, run numbers for you, get you pre-approved. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan. 616-293-2189.